week ago Saturday, the US and Israel started Operation Epic Fury, bombing Iran, rapidly killing the Ayatollah, along with many of the senior leadership of the IRGC. And shortly after, the Iranian regime started essentially a blockade of the Strait of Hormuz via attacking a number of different tankers and dry bulk ships that were attempting to pass through the strait in both directions and attacking energy infrastructure across the Persian Gulf region. There have been significant shut-ins, and there's been significant escalation in the conflict over the last 12 days. Right now, it looks like this is the largest oil supply disruption in history, and there's a huge amount of oil offline. More and more production is being shut in across various Middle Eastern countries, and inventories were already at low levels on a seasonally adjusted basis and maybe likely to collapse in addition to the strategic petroleum reserves of various Western countries, including the United States, over the coming weeks and months. So, as a part of this, it's been interesting to see how oil prices have reacted versus how oil stocks have reacted, with the oil stock indexes up quite a bit less over the last couple of weeks than the oil price, which is part of why I'm doing this. I do think that over time there's an observable high correlation between these stocks and the price of oil, and I do think that that will persist. There's various reasons why specific companies, which are large index constituents of the index for XLE and XOP, and even some of the other ones, why individual companies might be materially lagging due to Middle Eastern operations and potentially not being able to benefit from the increase in price and potential activity level. And so I think it's never been more interesting as an energy investor to be picking specific oil stocks that may be substantial net beneficiaries of the situation, both from higher oil prices as well as from not having their operations impeded or not materially impeded like many of their peers, which may be a major factor in temporarily holding back the performance of ETFs and indexes like XOP. And like I showed in that disclaimer, I do have exposure. I have financial exposure, beneficial exposure to these indexes as well as some of their components. And none of this, again, is meant as an offer, solicitation, or recommendation. Please do your own diligence and consult an advisor. So leading into this, we already had seasonally low inventories. We had this promise of a super glut, even though we were at a quite balanced market. And from a longer term perspective, there had been material underinvestment in global upstream oil and gas exploration, delineation, and development, which led to essentially catastrophically low levels of reserve replacement across the industry. This is one of the biggest pushbacks I've been getting over the last couple of weeks for remaining bullish on oil stocks and on oil is this perception that this war will end soon, which I frankly hope it does. And then this conception that there's going to be this huge glut of oil and easy oil to come online. And to that, I would point you to this top right chart where there's been very, very few new discoveries. New discoveries have been the things that have really crushed the oil market over time. And without large new discoveries pushing down the cost of supply, it's very difficult to construct a long-run bearish scenario for oil. In addition to that, oil demand is growing quite robustly, or at least it was until oil prices spiked and product prices spiked even more in the last couple of weeks, growing by 1% plus per year, almost every year for the last 40. And even countries like China that supposedly had moved off of increasing oil demand and supposedly were thinking about how to say this. Supposedly they had hit their peak oil demand. The data does not support that. And recently they were importing record levels of oil. That does seem prescient to some extent. That being said, with China not exporting refined products despite huge margins and despite significant financial stress on the Chinese central government and various local governments. I think there's something to this in terms of China's oil demand having stayed quite robust and having continued to grow over the last number of years despite the headlines. And then broadly, oil demand has been persistent and has continued to grow as the world has grown and gotten wealthier. On a per capita basis, wealthier countries consume more oil, even if they've pursued the energy transition agenda quite aggressively. And even if countries like China and India may never hit the per capita consumption that the US currently enjoys of oil, they may still dramatically increase their consumption on a per capita basis from current levels, along with many other countries along this trend. So I'm now going to talk a little about a few of these high upside stock ideas that I've shared here on Bison Insights. So the first one, and for the benefit of subscribers, I'm not going through the specific names of these. A couple of these I've actually I think maybe all of them I've talked about publicly in other venues. It's possible through great effort you may figure out sort of which names they are. It's not a state secret. I'm just trying to be respectful to the paying subscribers for Bison Insights for this. So the first idea, the stock, it trades at a very high free cash flow yield, and it on a enterprise value basis and even on a market cap basis. And so, or sorry, even on a enterprise value basis, but especially on a market cap basis. And it's just too cheap. And so, this one is a services company, and it did have some Middle East exposure, but it's actually lost some of its affected Middle East exposure even prior to the conflict, which has actually suppressed their price. So I think their stock probably would go up a lot independent of this current situation. And then with rigs and pressure pumping and various other oilfield services activity likely to respond to the extent that the current conflict continues, I'm really excited about companies like this one that have most, if not all, of their upside exposure in services in North America and other advantaged jurisdictions. This one trades at a huge discount to its book value, to its likely replacement cost, to their estimate of replacement cost, to my estimate of their replacement cost, and even potentially to their liquidation value based on recent transactions for similar equipment and similar operations. So I think it's really helpful to own services companies that are very equipment intensive at large discounts to replacement cost, particularly at low points in the cycle. I've done this a few times before over the course of my career, and it's actually one of the most consistent and most lucrative kinds of investments that I've done professionally and personally over the last 20 years. I really like this whole buy companies at a big discount to replacement cost, sell them when people start trading them based on earnings and when they trade way above the replacement cost. And this one is somewhat unique in that it's very rare to find companies that are both trading at a large discount to replacement cost and are generating a lot of free cash flow. So that combination is very powerful and I think offers a lot of upside leverage to the extent that we go into an upcycle, which to the extent that this situation in the Strait of Hormuz continues, we almost definitely will be. And then I think people don't really appreciate how powerful paying down debt can be for equity returns. And I think it's because the returns from it tend to be uneven over time. So some of the initial debt pay down sometimes just leads to a derating in a stock. Stock price may not move up much, but over time, it can be extremely powerful and nonlinear, where the first dollar of debt paid down might yield no improvement in market cap and just a smaller enterprise value. But the 500 millionth dollar of debt that pays down, that $1 might yield a $5 increase or $10 increase or $0 increase in the market cap, sort of depending on where the leverage is at what point the market starts to get excited. I've found that there tends to be sort of the most excitement around debt paydown when it transitions over to dividend payments, share repurchases, revenue growth, various other activities, acquisitions even. That's where I've found these companies get most rewarded for their debt paydown. But I like to own them as big chunks of the debt are getting paid down because it's somewhat hard to predict exactly when they're going to flip to returning capital. And I want to make sure to be there so that I can catch the upside, as well as in this case, catching the likely cyclical upside. There's really just this huge benefit for these cyclical services companies that are also generating a lot of EBITDA and a lot of free cash flow despite being at a low point in the cycle. And especially here where we've seen oil prices go up a lot and some of these stocks are not up much or even down. And this one I found compelling, and I'm sort of astonished that it's not doubled or tripled as oil prices have soared. So, to put some numbers around that, I see upside to replacement cost for this company over 500% versus its current share price, partly because of the financial leverage and partly because it's at such a huge discount to its replacement cost. And then, um, when I think about it from a multiple perspective on cash flow and on free cash flow, there's also several 100% to the extent that we get sustained moderately high oil prices. I don't even think $100 oil is that high in the sense that if you uninflation adjust it, it's closer to $60 oil, let's say 10 years ago, which was a number that was considered so low that it sent activity levels way down and it sent profitability across a number of different oil and gas companies way down. Giant companies like Exxon and Chevron and so on saw a massive derating in their stocks as oil went from $100 back in 20, let's say 13, which is essentially $150 oil today, down to $60, which again, I think is close to $100 oil today. And you saw those stocks crash on that because of reduced profitability. So I think we're still in a very depressed price environment, rapidly improving. But I know it sounds sort of like heresy to underwrite to $100 oil, but here we are very close to it. And the upside for some of these companies, to the extent that prices are able to stay here or go even higher and stay there for a while, is astronomical. Here's a second idea that's similar. This company is rapidly growing production from a high return shale play while also building out high value infrastructure that's taken longer, cost more, and sort of generally disappointed the market. And I think this one has stayed cheap because the market had trouble processing, and certainly the investment banks that I follow that track it had processing in attributing this essentially new co on the infrastructure side from the existing co in terms of allocating growth capex versus maintenance capex. And so as that growth capex turns into free cash flow and EBITDA for the company, I expect a re-rating and then also from their very high rate of return reinvestment. And this is something I'm working more on this particular idea in terms of highlighting how much more upside there is, which I expect to put out at some point next week in terms of illustrating sort of the different ways that this particular company and similar companies can win from much higher oil prices. So the upside to the cash flow multiple and the upside to the net asset value is multiple 100% from where it's trading. The stock has been moving up, so that's good to see. There's some validation from a market perspective, and I see room for much, much more. And this company in particular has a lot more upside to higher oil prices than its peers, partly again because I think the stock was held back because of the heavy infrastructure spend, which is now rolling off as those infrastructure projects come on, um, as well as their immense leverage to higher oil prices due to the nature of their properties, which were lower margin at lower prices, and where there's just enormous cash flow convexity for this company as oil prices rise like they have. And now, just a brief moment on the third idea. The This company has huge upside to its free cash flow yield. It generates way more free cash flow than many of its peers. It actually has a lot of hedges in place, and I think there's a misconception. Obviously, unhedged oil producers should benefit more than hedged oil producers because the hedged ones have their oil contracted to sell out at a lower price. This one has a portion of its production hedged, so it has some downside protection, I would argue, locked in, where it was already going to generate a very robust free cash flow yield relative to its current stock price, even after its recent move as oil prices have risen. And to the extent that $100 oil sticks around, it generates even more free cash flow, which can be used to rapidly pay off debt, buy back even more stock than they've already been buying, maybe increase their dividend, or maybe accelerate development. This one has huge NAV per share upside from higher oil prices. This is very real in the case of this company. I actually think they've massively underbooked their reserves. They've done very intelligent acquisitions and divestitures, and a higher oil price environment, I think, is going to put some pressure on companies that have insufficient reserves and insufficient drilling inventory. And this one has a lot of drilling inventory. It's really exciting. What they have. And I actually think I wrote an article about this recently, how this particular company could carve off a portion of one of their assets and essentially pay off almost all of their debt and potentially re-rate many times versus where they're currently trading. Higher oil prices, I think, may provide them with a little more motivation, almost a kick in the butt to go transact a little on the divestiture side, especially given some of the reserves that they've acquired recently through some of their acquisitions. And so to the extent that they do that, there's room. The divestiture market is quite robust and is at a multiple higher than where the stock is trading. And because of this company's financial leverage, they in particular could benefit from divestiture of some of these assets, particularly if they sell some assets that have, let's say, less production and more inventory and reserves, where there's less of a hedge impact that they'd have to pay off in order to sell those assets. But realistically, even their most hedged, highest production, lowest inventory assets, they could likely liquidate at a large premium to where their stock is trading, even net of the likely hedge unwind on those assets. So this is sort of ideal for a company like this. And I think the market's just sleeping on this one. It's a large position. I've added more to it recently, and I'm really excited about the upside to this one, where I think even showing a 250% potential upside to the extent oil prices stay high is probably actually massively understating it because of the potential liquidation value. So, like I said, all of this is not an offer, solicitation, or recommendation. Please make sure to consult an advisor before making any investment decisions, and past performance may not be indicative of future results. And then just if you're curious about Bison Insights, and you're seeing this and aren't familiar with it, please come check it out, bisoninsights.info. You can email me. You can find me on X and obviously on Substack. So with that, I appreciate you taking the time and hope that you have a good day. Take care. And